Hello, everyone, and welcome back to the Financial Podcast. I'm Olivia, your host, and today we are diving deep into a financial maneuver that has sent ripples across global markets, hinting at a dramatic shift in how the U.S. government manages its debt and the broader economy. We're talking about the US Treasury's recent massive intervention in the bond market, a move that is absolutely unprecedented in its scale and implications. The big news this week revolves around Treasury Secretary Scott Bessant, who, in a bold and unexpected move, has stepped into what many are calling the Federal Reserve's empty shoes without even asking for permission. This isn't just a minor adjustment. It's a monumental $10 billion Treasury buyback operation, marking the single largest such operation in U.S. history. To put that into perspective, the Treasury's previous record for a buyback was a mere $3 billion back in 2000, which means this recent action is more than 3 times that size. This is not just a statistical anomaly, it is a clear signal that the Treasury is now wielding its own powerful tools to directly influence market conditions. Why is this happening now? Well, the bond market has been in a severe state of distress, as described in the sources, as careening toward a cliff. We've seen 30-year yields steadily climbing, dangerously close to a hair-raising 5% mark. This upward pressure on yields directly translates to higher borrowing costs for the U.S. government, an unsustainable path given the nation's immense debt. The conventional expectation in such situations is for the Federal Reserve, specifically Chair Jerome Powell, to intervene and calm the markets. However, the sources note that Powell has remained stubbornly twiddling his thumbs, maintaining a higher-for-longer stance on interest rates, seemingly unconcerned by the escalating market turmoil. This inaction from the Fed has created a vacuum, and Secretary Bessant has clearly decided that waiting for the cavalry is no longer an option. This isn't Bessant's first engagement with this issue. Flashback to April 14th, a date that some might recall as Liberation Day during President Donald Trump's administration, which, according to the sources, coincidentally sparked a significant bond sell-off. This sell-off was then amplified by a brutal unwinding of the staggering $2 trillion basis trade, leading to a dollar fire sale that swept from Tokyo to Frankfurt. It was on that very day that Secretary Bessant appeared on Bloomberg TV, attempting to soothe the frayed nerves of traders. During that interview, he casually mentioned his weekly breakfasts with Chair Powell, subtly hinting that if the Fed continued its inaction, the Treasury possessed its own muscular toolkit and could potentially scale up its Treasury buybacks. At the time, many traders dismissed this as mere rhetoric, a verbal intervention to calm the markets. But 6 weeks later, it's clear that Bessant was not just talking, he was setting the stage for what was to come.
What we're witnessing now is Bessant making good on that veiled threat, executing what has been called the mother of all Treasury buybacks. While many are familiar with quantitative easing, or QE, as the Federal Reserve's primary weapon for stimulating the economy and managing interest rates, this Treasury buyback operation is quickly being likened to a scrappy contender dubbed QE Light. Unlike the Fed's broad asset purchases, these Treasury buybacks are operating quietly but forcefully in an open market style, drawing parallels to corporate equity buybacks. The initial target for these buybacks was relatively short-dated paper, specifically securities maturing between July 2025 and May 2027. But the scope is rapidly expanding. On Wednesday, following this historic Tuesday buyback, Bessant's Treasury is scheduled to re-enter the market, this time targeting longer-dated bonds, those maturing between 2036 and 2045. Furthermore, the buyback limit for these longer-dated securities is doubling from $1 billion in May to a substantial $2 billion in May. This deliberate escalation sends an undeniable message to bond traders. The Treasury is drawing a bright red line in the sand, declaring that yields above this level are simply too dangerous, too costly, and too toxic. This aggressive scale-up from the smaller, more tentative buys in April, which were initially used to stabilize the market when treasuries were tumbling without any sign of a Powell put, a perceived readiness by Powell to intervene and support the market, is a highly calculated move. Bessant is effectively sending a clear and unequivocal signal to the market, and arguably directly to the Federal Reserve. If Chair Powell continues to sleepwalk through this period of market turmoil, the Treasury will not merely fill the void, it will aggressively reclaim control. For 2 years, we've seen Treasury issuance under former Secretary Yellen described as activist, flooding the markets with debt. Now, with Bessant at the helm, it appears we're entering a new era of activist strategy from the Treasury, characterized by turbocharged Treasury buybacks. This marks a significant pivot in how the U.S. government interacts with its own debt markets, moving from primarily issuing new debt to actively managing the existing stock of debt. The burning question on every trader's mind, and indeed on the minds of investors worldwide, is this. Has Scott Bessant effectively replaced Jerome Powell as the new sheriff in town for the bond market? Will the Treasury continue to be the primary actor in calming volatility and setting market conditions until the Federal Reserve finally decides to wake up and smell the sub-2% core PCE inflation? The answer to this question holds immense significance and could fundamentally reshape not only bond yields, but the entire landscape of financial markets globally. It highlights a potential fissure or, at the very least, a significant shift in the traditional roles of the U.S. Treasury and the Federal Reserve, two of the most influential financial institutions in the world.
This situation also brings into focus the broader political and economic climate under President Donald Trump's administration. While the specific trigger for the April 14th bond sell-off mentioned was a broader market event, the fact that these significant interventions are occurring during his presidency adds another layer of complexity. The willingness of the Treasury to act so decisively, almost independently of the Federal Reserve, speaks volumes about the current administration's approach to economic management. It suggests a proactive, hands-on strategy to address market instability, even if it means stepping into territory traditionally occupied by the central bank. This independent action by the Treasury could be seen as a strength, allowing for swift responses to crises, but it also raises questions about the coordination and mandates of these powerful governmental bodies. The immediate effect of these buybacks is to reduce the supply of outstanding Treasury securities in the market, which typically helps to push down yields. By purchasing back its own debt, the Treasury effectively creates demand, which helps to stabilize prices and lower interest rates on those specific bonds. This can provide immediate relief to the government's borrowing costs and help to prevent a further unraveling of bond prices. For investors, particularly those heavily invested in longer duration bonds, this action by Bessant could be seen as a protective measure, preventing further losses and potentially even creating opportunities for capital appreciation as yields stabilize or fall. However, the long-term implications are still unfolding. Will this new activist stance by the Treasury become a permanent feature of U.S. economic policy? How will this dynamic play out if the Federal Reserve eventually decides to become more active? These are the questions that will define the market narrative in the coming months. It's an intriguing development to observe how the U.S. Treasury is now employing strategies that bear a striking resemblance to central bank operations, particularly in its scale and intent to directly influence yields. This departure from conventional roles signifies a potential new chapter in the interplay between fiscal and monetary policy. Whether this is a temporary measure or the harbinger of a more permanent shift, one thing is certain. Market participants must now closely watch not just the Federal Reserve, but also the U.S. Treasury, as both entities are actively shaping the financial landscape. The days of simply shrugging off Treasury rhetoric appear to be over. Bessant has proven that his words are quickly followed by decisive action, a lesson hard learned by those who dismissed his previous statements.
This direct intervention by the Treasury could also have broader implications for other asset classes. If Treasury yields are stabilized, it might reduce the attractiveness of safe haven assets like gold, which, as the sources mention, has already seen declines on renewed USD strength. Conversely, a more stable bond market could provide a firmer foundation for equities and other risk assets, potentially leading to a risk-on sentiment. However, the interplay is complex, and unexpected shifts in policy or market sentiment can quickly alter these dynamics. For instance, the impact of non-farm payrolls data on currency pairs like Euro USD and GBP USD, or the significant sell-off in Tesla stock due to other specific concerns, reminds us that the market is a tapestry of interwoven factors. Ultimately, this bold move by Secretary Bessant is a powerful demonstration of the Treasury's capacity and willingness to act independently and forcefully to maintain stability in the U.S. bond market. It's a clear signal that the government is prepared to use all available tools to manage its debt profile and borrowing costs, especially when traditional actors, like the Federal Reserve, are perceived to be less engaged. The coming weeks will be crucial in determining the lasting impact of this QE-light approach and whether it truly ushers in a new era of Treasury dominance in bond market management. It leaves us with a compelling narrative about authority, responsibility, and the evolving roles of financial institutions in the face of unprecedented challenges. Thank you for joining me on this deep dive into the latest market developments. I hope this discussion has shed some light on this incredibly significant event. Remember to always stay informed and do your own due diligence in the ever-changing world of finance. Until next time, I'm Olivia, and this has been The Financial